EduTrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your EduTrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. Steve Savant here, your EduTrainer. And of course, I am also the host of the Business Insurance Zone, as well as I'm a national insurance columnist. I blog, tweet, and write articles on a lot of our tactical and strategic issues using life insurance. And we're doing the entry-level life insurance program. All this week we've been doing the history, some of the introduction into life insurance. Before we get into it today, I want to be able to show you something. We're brought to you by Lincoln Benefit Life, an Allstate company, and I want you to look at this Eclipse illustration software, because about a week from now we're going to be on this system for a long time, and I want you to be able to download it at www.lblsales.com/ETW. When you go ahead and download this, this is one of the easiest software packages. If you're coming into our business from the medical field, or from property casualty, or from securities, or the banking system, just to name a few vocations that are people that are coming into our business, you'll want to use a software package that'll be a great introduction to you. And I have to say, we voted this, again, the most easy, friendly user software that we have, and I want you to download it so that you'll always have it, and you'll be able to go illustration, or proposals. When I'm working on it, you'll be able to work on it. Now, if you were in yesterday's class, I gave you a little bit of history, and I want to just kind of review a little bit about that, because what I'm trying to do is trying to give you some ideas to stretch your thinking. Yesterday, I showed you how to do block math mechanics, and just as a really quick review, block math mechanics in the old days, this is how they did mathematics. 85 times 85. 5 times 8 is 40. 8 times 8 is 64. 8 times 5 is 40. And 5 times 5 is 25. Put that 40 in there. The total in this triangle is 5. In this trapezoid is 2. In this other trapezoid is 12. Carry the 1 is 7. 7225. But now I want to show you how you can do this in your head. For example, 85 squared. 5 times 5 is 25. I want you to park it on the side of your thinking. 8 times 8 is 64. Plus 4, right, is 72. 72, and I park 25 over here. The answer, 7225. Let's do another one. 75 squared. 5 times 5 is 25. 7 times 7 is 49. Plus 7 is 56. 5625. Or another one, just as an example of reinforcement, 65 squared. 5 times 5 is 25. 6 times 6 is 36. Plus 6 is 42. 4225. So going back to our example here, 85 squared. 5 times 5 is 25. 8 times 8 is 64. Plus 8 is 72. 7225. So whenever you're thinking about this, you're looking at math, I'm trying to stretch your thinking, and I'm just using these as nice introductions to our seminar and our workshops. When you think about what we're doing today, we're going to expand a little bit about why are we talking about life insurance. And when we're talking about life insurance, I'm looking at 3 basic ideas. There are some nuances and some subtitles, but I want to talk about the first one, which is the main reason why life insurance was invented, which was to pay a death claim, or the word we use in the official MBA language, if you want to use that kind of language, indemnification. I want to indemnify somebody at the loss of another person's life. So indemnification, or I want to buy coverage, or I want to go to the place where I have protection. So if I'm a father, and I have a wife and children, and I have debt, and I have future dreams that I want to fulfill, I'm going to put life insurance on myself, and so that my wife and my children are taken care of, whether I'm here working or if something happens to me, I know they're provided for. When you think about it, indemnification is, will somebody suffer loss if I'm not around to earn income? Will somebody experience an economic catastrophe because they don't have income coming in? And will the dreams of a family or even a business suffer because I didn't think into the future to cover the possibility of our death? We all know that we're all going to die, we just don't know when. And life insurance covers that possibility during our time. We have a life expectancy, how long we should live, but we just don't know if that's going to occur specifically for us. We know the statistics in the United States are high. A person of my age and my health category, I should really see 85 to 90, no problem. But remember, things can happen. Life just happens. So, the number one thing about indemnification scenarios is I have to justify the death benefit. Now, I could ask for a $20 million death benefit, but then I have to show financial wherewithal. I have to justify the amount of money that I'm asking them to cover me on. Even if I can afford it, I have to be able to justify it. Some companies use what we call the income rule. Maybe I'm a young doctor. Perhaps I'm just new in the business. And as I'm coming in new in the business, I'm really not sure, I have this great possibility, this great potential of my practice. But right now I'm early on in my practice and maybe I'm not worth $5 to $6 million. But because I'm making serious six figures as a surgeon, as an example, they'll let me do maybe 10, 15 times my income as my death benefit coverage. So I might be able to get $3 or $4 million, $5 million without justifying the actual loss of it based on income. Indemnification, when I look at it at a basic level, I look at it in four ways. Are you a SINK, a SIRK, a DINK, or a DIRK? Let's just try to do this because that's a little confusing sometimes. Let's just do this, clear the board. Let's say you're a SINK. Single income, no kids. So when I look at you, right away, I start partitioning in my mind, what am I doing? What do I have to cover? Is there any coverage issues here with a single insured with no kids? Well, they're still going to have debt issues and so forth and so on. Maybe they have nephews, nieces, moms and dads, people depending on their income. So I'm going to look at a single income, no kids, and I'm going to say, how can I indemnify? How can I protect their beneficiaries? How can I get coverage for a SINK? A SIRK. A SIRK is single income raising kids. And today, one of the greatest, largest growing demographics are females, single households raising children. Single income raising kids is now becoming a monster demographic in the US. So my job is, I have income that I need. Now let's say our SIRK, our female, has a husband, or an ex in this case, we'll want to cover him as well. But let's say I really don't have that, or he's derelict in his duties. SIRK, single income raising kids, I'm going to see what it takes to make sure that those kids are taken care of, and I'm going to make sure all her debts are paid off. If something happens to her, I want to indemnify her children, her beneficiaries, so if anything does occur, that they're taken care of. So I'm looking always, is it a SINK or a SIRK? Then I'm looking at a DINK. Dual income, but no kids. Most households today who have a mortgage are predicated on two incomes. I look at dual income, no kids. I want to take care of, make sure that if one of the dual income isn't there, that everything they're into, whether it's all their debt on cars, credit cards, mortgages, and student loan obligations, anything in their future that has to be protected as a dream, if one of those two dual income couples, if one of them out of those two actually dies, I want to be able to cover it. So it's dual income, no kids. Here's the bigger one, a DIRK. What if it's dual income raising kids? Well, now I have to protect not only my partner, I have to now protect the kids that are involved in this. So when I'm looking at indemnification, when I'm looking at coverage, when I'm looking at protection, my first thought is I need to cover all the eventualities, and we're going to get into that next week, all the eventualities, anything that could happen. I want to cover off all debt. I want to cover off incomes, loss of income. I want to be able to do everything I can to indemnify, to cover, and to protect. And I look at these four basic domestic or family ideas: SINK, SIRK, DINK, and DIRK. Single income, no kids. Single income raising kids. Dual income, no kids, and dual income raising kids. Now remember, I might have business issues as well. So I might be in a partnership and I'm my age, let's say we're both of our partners, we're relatively the same age in our 50s. When we look at those numbers, we say we both own half the business. If something happened to that person, my partner, I am now partners with the wife of my deceased partner. So I have to be careful here. I want to make sure that if something happens to him, I'm covered. If something happens to me, he's covered. Now, there's many ways to cover this. I have to, first of all, again, justify the death benefit. So I can't just ask for 10 million when my business is only worth 1 million. I have to be able to prove financial justification. And so I'm going to go through business scenarios and look at indemnification and figure out what's the best way to indemnify, to protect, or to go ahead and cover any partnerships, whether it's one or multiple partners. In many ways, we use different kinds of buy-sell agreements and we fund it with life insurance. Now, one of the reasons that businesses like life insurance overall is because it's a leverage transaction. It's a discounted dollars transaction. It has tax advantages to it. Now, a lot of those advantages are still with family planning, but in business, it's even more enhanced because there's the tax advantage, the leverage, and the discounted dollars. When you see some of the math we're talking about later on next week, you'll say, wow, I cannot believe, bang for the buck, discounted dollars, the leverage of life insurance is huge. And that's why we use it, because it's so good. And remember, the price tags are coming down all the time because we're living longer, as I said in our first show. So when I come to you and I say, these are the considerations, my second consideration is businesses. Who am I in partnership with? I want to indemnify all my partners for death. And by the way, even though we're not talking about it, death and disability are the big ones. So when I'm looking at contracts for businesses, for business succession planning, I'm going to be looking at how can I justify the amount that I'm going to ask for? How many partners are involved? Do they have equal shares? All these things I have to accommodate in an indemnification scenario so that I know I'm covering it. Now, in some scenarios, when we're talking about indemnification, we're also talking about the ability to take on new beneficiaries. For example, if my parents are dependent on me, they become new beneficiaries because they would suffer economic loss because I'm taking care of them. So if I have my generation in front of me, my parents, and I have my children below me, I have two generations. I'm taking care of my current obligations. I'm also taking care of my parents. This is a whole new demographic. And I'm also looking at the possibility of having to take care of my kids. Even though I thought they were gone, they might be coming back again, and I might have economic issues. So I want to look at all those economies, the justifications that go with it. And remember, it's really interesting to note, in indemnification scenarios, most of what I've seen today is if the husband and wife in a dual income scenario, whether it's a DINK or a DIRK, we are still not accommodating for the female spouse in this equation. Many times we are not doing equal treatment, or we'll throw a rider on the male for the female. But in my view, we should start to look at indemnification as way bigger than that. And so when I have dual income, I want to put both people on their own separate contracts. I want them to be able to have equal footing because much of the mortgage, debt, auto loans, student loans, future obligations, retirement is predicated on two people. So it's very important not to leave the female spouse out because now she's a major player. And remember, females from a demographic point of view own the purse strings in the household, and you want to be able to address that. And by addressing it, you're covering the dual income no kids sector and the dual income raising kids. So it's important always to think of all the indemnification. Who will lose by this death? Who will suffer economic loss by this death? How many people will actually experience some kind of financial catastrophe? And that's what I'm trying to always cover off. I'm going to make the list of everybody that my client or my potential client or my prospect, whatever their potential is, I'm going to list that on a piece of paper and try to cover it off and then figure out what's the value, what do I need to cover? And I have to justify it. That's our first section and talking about indemnification.
This has been an EduTrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.